ChartMill has been around since 2008, and as we continue to grow, we receive more and more feedback and questions. And one specific question that appears regularly in our inbox is the following: which strategy offers the best chance of success, and which filters should I use to find those best setups? Now, as much as we would like to give a straight answer to that question, that won't happen anytime soon. There are just too many different variables to simply give an all-in-one answer that applies to every investor or trader out there. Since many beginners seem to struggle with the same question while having a lot of doubts about how to get started, I've created this video. I will elaborate on 6 aspects that form the guidelines of a complete workflow to arrive at the final selection of stocks to trade. Keep in mind that these insights are based on my personal experiences and are therefore subjective. So the first one, how to gain an idea of the general market trend and market sentiment. What specific strategies are appropriate for different market trends? Which screens are suitable for each of these strategies? How to create a watch list of potential setups? And then the Holy Grail, risk management. How do you determine the entry, stop loss and position size of a setup, and how to manage an open trade? And finally, the trading journal. What data is important to analyze your results so you can recognize any weaknesses in your strategy and adjust it as needed. You can get a quick picture of the general market trend by simply looking at the broad market indexes on a long-term weekly chart. I use the 4 US index ETFs for this purpose, being the Dow Jones, Nasdaq, S&P 500 and the Russell 2000. You can check these via the homepage. I have these 4 ETFs stored in a watch list so I can easily access them from the stock charts or stock screener page. The long-term trend is shown using the ChartMill trend indicator. This is a 30-week average line, which is the equivalent of a 150-day average on a daily chart. The advantage of this specific indicator is that the color changes according to the trend. Red is negative, green is positive, and gray is neutral. There is an article available on the website that explains a bit more about this indicator, and I will put a link in the description below. You can of course use other parameters to determine the main trend. For example, the 200 daily moving average in combination with the 50 and 20 daily moving average on the daily chart are also widely used. If the index is trading above the 200 SMA, the long-term trend is bullish. The 20 and 50 SMA on their turn give more insight into the short and medium-term trend. Similarly, I have a watch list containing the 11 US sector ETFs, which I can quickly access this way. But merely considering the major indexes is not enough. In fact, it is not always an accurate representation of what is really happening in the market. For example, the S&P 500 is a market capitalization weighted index, and as a result, the companies with the highest market capitalization have the biggest influence on the value of that index. The S&P 500 may consist of 500 companies, but in reality the performance is much less diverse, and it is mainly the Magnificent Seven that determine the direction. These are Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta and Tesla. Just these 7 companies together make up nearly 30% of the total S&P 500 market cap. Therefore, it is best to check the individual stocks from the index. To do this, go to the stock screener and select Index drop-down list from the General menu. Click on S&P 500 Index. Only stocks from that index are now being displayed. Next, go to the TA Indicators menu to check which stock's long-term trend is positive. To do so, open the ChartMill Trend drop-down list and select Long-term Trend Positive first. Currently, there are 260 stocks in the index whose long-term trend is positive. Next, change the selection to long-term trend negative. 121 results are now appearing. And finally, we select long-term trend neutral and we get the 122 remaining stocks. Likewise, you can do this for the short term. Once again, applied to the S&P 500, 57 stocks show a negative short-term trend and 365 stocks show a positive short-term trend. In exactly the same way, you can check stocks from other indices or even specific sectors. This way, you get a much more nuanced and reliable picture of the overall market trend than if you merely consider the index. A second way to measure trend and sentiment is to look at stocks that have just reached or are close to their 52-week high or low. As an example, I show the Nasdaq 100 index. Through the General menu, I first select the Nasdaq 100 index, then choose the Performance tab. and from the drop-down list under Signal, click on New 52-week High. Other options such as the 5, 10 and 20-day high are also available through this menu. ChartMill now only shows the corresponding stocks. Next, take a look at the number of new 52-week lows and compare this number to the previous one. You get an even more nuanced picture if you look at the number of stocks that are within 5% of a new 52-week high. Therefore, select within 5% of 52-week high and then again for the option within 5% of 52-week low. You can do this kind of screening for any index, and in this case we selected the predefined option within 5%. But ChartMill allows you to fine-tune that even further. Via a custom screen you can change that 5% to any desired percentage in a few clicks. For example, suppose we want to find out how many stocks in the Russell 2000 index are trading at less than 1% of their 52-week high. First, we select the Russell 2000 index via the general menu from the index drop-down list. Since the option within 1% of 52-week high is not available by default via the Signal drop-down list in the performance menu, I use a custom filter for this purpose. Open the custom menu and for the left-hand side of the equation select Property and then click the inverted triangle again. Now choose General and then Last Price. For the comparison, first select Less Than, and for the right hand side select again Property and then Range and 52-week high. With this first custom filter we have defined that the price of the stocks we are looking for must be lower than the 52-week high price. Then we define a second filter that determines the maximum distance from that 52-week high price. In this case we are going to set that maximum to 1%. So for the left hand side of the equation I again choose Property and then General Last Price. For the comparison this time select Greater Than or Equal To. And then for the right hand side first select Expression where a submenu appears. For the left hand side select once again Property, Range 52-week high. For the operator choose the multiplication sign and for the right hand side select Constant. Because we want the price to be maximum 1% lower than the 52-week high, we multiply with the value of 0.99. And as a result, I now get to see all stocks whose last closing price is less than 1% below the 52-week high. One last important part that we certainly cannot ignore in this video is the sector page. It can be accessed from the main menu on the left. Why is it a good idea to keep an eye on this page and check it regularly? Well, each new bull market is characterized by a number of sectors or specific industries within those sectors that will lead the way in the new uptrend. And the sooner you recognize those specific industries, the easier it becomes to identify the new leaders in the bull market. Sector performance can be ranked on different time frames. It gets even more interesting when you select a specific sector. On the next page, you can then fine-tune by industry group or specific industry. You can now do exactly the same thing we did with the indexes. How many stocks from this industry are trading above their 200 daily moving average? Or how many stocks are close to their 52 weeks highs, 20-day highs, 10-day highs, etc. If, while screening, you suddenly see multiple setups from the same industry or group appear, that is a first indication of relative strength. If so, be sure to check the rest of the group as well. You may be dealing with one of the industries that will take market leadership in the new bullish trend. No strategy works across all market conditions. Markets are constantly changing, and so it stands to reason that something that works in a typical bullish market environment will not do as well when that market environment changes. And that is true for both the fundamental investor and the technical trader. A quality investor may have the healthiest and financially strongest companies in their portfolio, but if the market trend and accompanying market sentiment is extremely negative, even those stocks will not escape a sharp decline. A typical breakout trader who books one profit position after another in a bullish market will suddenly be faced with multiple consecutive false breakouts when the market turns. Both the investor and trader will have to adjust to this new market reality, but for both it can be very different. The quality investor does so by keeping a close eye on the company figures. If the earnings and revenue remain at an acceptable level and the company has more than enough cash and little debt to cope with a temporarily sluggish economy, then all that is needed is patience until the market returns to normal. There may be even opportunities to buy additional shares as the price falls. A breakout trader who is stopped out in several positions in a short period of time may initially reduce the risk percentage on new positions, but if it appears that the market trend is effectively changing for a longer period of time, fewer setups will appear with the same screener. And moreover, chances are that few of these setups will still be successful. The trader will then go 100% in cash or perhaps switch to another strategy that better suits the new market reality. Those who opt for the pure fundamental approach don't need to worry much about the various market phases and sentiment. Regardless of which fundamental approach you apply, the main focus will be on the product or service being provided by the company, the management itself, and the company figures. In ChartMill there are several predefined fundamental screens available, and these are best explored through our Trading Ideas page. Select the Trading Ideas page and choose Fundamental Analysis Only from the drop-down menu. From Other Settings, select ChartMill Screens Only, and you now get to see all fundamental screens. If desired, you can further refine by methodology. Options are Value, Growth, Dividend, and Quality. Clicking Run will take you directly to the stock screener page with all stocks that meet the criteria. Clicking on More Information takes you to a page that provides more details about a specific screen. Among other things, you will find the corresponding documentation in the form of articles or videos and a list of all individual filters used. From here, you can activate the screen by clicking Run. You also have the option to launch a regional run from this page. You can choose to apply the filter globally or just for the US, Europe or Canada. Regarding fundamental strategies, there are several screens available that were developed based on the selection criteria of well-known investors such as William O'Neill, Peter Lynch, Terry Smith, etc. Or you can browse the screens compiled by ChartMill itself. The screens that use both fundamental and technical elements can be recognized by the reference on the corresponding thumbnail in the Trading Ideas library. They will always appear whether you select technical or fundamental analysis. Some screens start from a technical approach and add fundamental elements, and other screens focus more on the fundamentals and add specific technical elements in order to add a timing element. Now let's take a closer look at some of these combination screens. One very well-known screen that uses both fundamental and technical elements is undoubtedly William O'Neill's CanSlim strategy. Initially, the screen defines certain requirements regarding the growth and acceleration of a company's sales as well as earnings, both on a quarterly and annual basis. In terms of technical filters, the letter N from CanSlim refers to new highs of properly formed chart bases, and O'Neill also introduces the concept of relative strength. This is a number between 0 and 100 that indicates the percentage outperformance of all other stocks for this stock. Price breakouts from such price bases should occur with sharply higher volume, as evidence that interest in the stock is high. From the basic trading idea, you can easily add such a condition in the stock screener through the Technical Analysis Indicators menu using one of the options below the Volume Increase tab. In this case, I show the results with the option Volume 50% more than previous volume. Only 3 results remain where the ticker Joe stands out in particular. The long-term trend is bullish and the price is currently in a sideways price range after an initial rise. The stock breached the high in that range last Friday with twice as much volume as the day before. A final technical element that O'Neill implements is the long-term price trend of the market. He endorses the importance of the prevailing market direction and recommends buying interesting companies that meet the criteria only in rising markets. This article summarizes the main point and his book is highly recommended. The combination screens that I use frequently myself are the various Minervini screens. Mark Minervini, 2-time US investing champion, has been using a combination of technical and fundamental elements for 40 years and has achieved downright fantastic results. Proof that he is not a one-hit wonder is the fact that he won the championship the first time in 1997 and repeated it 24 years later using the same strategy. Minervini, however, unlike O'Neill, starts from a technical perspective. Before a stock can be retained as a possible setup, it must meet its trend template, which by the way is available as a separate screening filter in ChartMill. This screen is a combination of multiple moving averages and specific price conditions. There are also requirements for the maximum distance of the price from its 52-week high and low. The other Minervini screens each focus on earnings or sales or profit margins. These fundamental filters distinguish quarterly from annual results. And I previously wrote 2 extensive articles on its specific entry point analysis. Think and Trade Like a Champion Part 1, Technical and Fundamental Filters, and Think and Trade Like a Champion Part 2, The Trading Strategy. Both O'Neill and Minervini use breakouts to open positions. Tip: on my Twitter page I maintain a live paper trading account based on these Minervini screens. Of course, it is possible to add your own technical analysis components to any fundamental screen in our database. For example, the trading idea based on at-quality compounding is purely fundamental. If I use only the regional filter US, I currently get 45 results. Suppose I want to add a trend filter based on the price relative to the 200 daily moving average. More specifically, that price should be higher than the 200 SMA. To do this, go to the Performance menu and open the drop-down menu under Price versus SMA, and then select Price above SMA 200. Only stocks in a rising trend are shown, and the number drops to 35. Want to further refine your selection based on a specific technical indicator? Select the Technical Analysis Indicators menu, and let's take the RSI indicator as an example. Open the drop-down menu and specify that the RSI indicator should go up, but still quote below 70 to avoid overbought conditions. As a result, the total number of stocks meeting these specific technical and fundamental criteria drops further to just 5. The numerous options to combine fundamental and technical features in one screen make ChartMill one of the most versatile stock screeners out there. Technical screens come in many shapes and sizes, and unlike fundamental screens, the success rate of such screens is largely dependent on different market phases because they focus much more on the short to medium term. In the drop-down menu, you will find the following strategies purely based on technical analysis: breakouts, momentum, mean reversion, and pullbacks or retracements. One of our most popular technical screening filters is the bull flag pattern. This is a technical continuation pattern which can be observed in stocks with strong uptrends. The pattern takes shape when the stock retraces by going sideways or by slowly declining, after an initial big rise in price. When you see the graphical representation of this pattern, you'll notice that it somewhat looks like a flag on a pole. ChartMill is able to autonomously recognize such patterns in the price chart. If the flag is not visible in the chart, you can add it via the Chart Settings menu. Tap the plus sign in the main chart settings and select ChartMill flag as overlay on the chart. The flags are automatically drawn by ChartMill. As mentioned before, not all technical strategies work equally well in every market phase. The prevailing trend and market sentiment plays a major role. It is important to have a clear understanding of the broad market conditions, and how to do that was already covered earlier in this video. To determine the trend for an individual stock, I always study the daily and weekly charts together. ChartMill has a specific view called 2 charts for that purpose, and when I select that option, I get a daily and weekly chart of the same stock. I use the Minervini trend template to get a quick overview of the current mid and long-term trend of any particular stock. On top of that, I've also plotted the 10-day moving average to gauge the short-term trend. And I have saved that chart configuration in my personal account and called it Minervini Advanced Trend Template. So the moving average are the 200, 150, 50, 20 and the 10-day moving averages on the daily chart. And on the weekly chart, those are the 30 and 40 weekly averages. For stocks that are rising sharply and thus showing a clear uptrend, you will see that the moving average with the longest period lies the lowest, followed by the other moving averages. The opposite is true for stocks in a clear downtrend. And in addition to the moving averages mentioned above, I also use stage analysis to determine the long-term trend. A distinction is made between 4 stages. Stage 1, which is the consolidation phase. Stage 2, accumulation. Stage 3, distribution. And stage 4, capitulation. And you can read more about stage analysis in this article, Stan Weinstein, Stage Analysis in ChartMill. There is a stage analysis indicator available in ChartMill that can be very helpful if you're not quite familiar with the stage analysis concept. It is meant to be used on the weekly chart. Personally, I determine the different stages manually, looking at the sequence of tops and bottoms to determine the corresponding stage, but it takes some practice and experience to master that properly. In this way, you will have a quick and accurate overview of the trend of the daily and weekly chart for any stock in your watch list or portfolio. Just as a reminder, no matter what strategy you choose, there will always be periods and circumstances when the strategy performs outright poorly. And although as a fundamental investor you will not distinguish between different investment styles adopted to the prevailing market conditions, for my own fundamental portfolio part I maintain one simple rule. I will never take a position in a stock whose long-term trend is downward. No matter how cheap or undervalued the stock may seem, I will never try to catch a falling knife. To determine the long-term trend, I use the ChartMill trend indicator on the weekly chart, but you can just as well use the 200 simple moving average on the daily chart, whatever you prefer. As an example, I am showing you the Garmin stock. This is a long position from my personal portfolio, which I have held since October 12, 2023. It is considered a quality stock. The stock came into my sights because it was one of the few results from Terry Smith's Quality at a Fair Price screen. The green horizontal bars in the chart are the price levels where you could read recommendations on all kinds of social media and forums that it was the time to buy Garmin shares. And if you look at the chart, you can indeed see that those levels correspond to previous resistance levels where the price finally managed to break through. And from a technical perspective, you can indeed expect some support at those levels. However, that assumption goes completely against the prevailing long-term trend shown on this chart by the ChartMill trend indicator. Also consider the volume. The largest volume blocks occur at falling prices. There is clearly distribution with large parties selling Garmin shares. Now compare this to the price trend from 2023. The ChartMill trend indicator becomes neutral and the price moves sideways after the price bottom in late September 2022. Volume also changes. We now see the largest volume blocks when the price rises, a sign of accumulation. The blue bar shows where I opened a long position in Garmin. For traders who do rely heavily on price action, the importance of the prevailing market trend cannot be overemphasized. It largely determines the success of your strategy and the setups that follow. Reducing positions or stopping altogether when market conditions are against you will largely determine the extent of your success. In the overview that follows, I have provided the most ideal market and setup conditions for a number of technical strategies. Keep in mind that these are only general guidelines. There will always be stocks that rise sharply when the broad markets are negative and vice versa. So do not consider these guidelines as a truth set in stone. Ultimately, you will have to discover yourself which strategy works best for you and in which market conditions you feel most comfortable. For bullish breakout and momentum strategies, the general market trend must be positive. In neutral or negative markets, the likelihood of false breakouts is just too high. Setup conditions. This strategy is suitable for stocks that have been moving within a neutral range for some time after a long-term decline, a stage 1 consolidation, or moving sideways after an uptrend, a stage 3. It's suitable for stocks in an uptrend, stage 2 accumulation, in which many stocks are relatively close to their 52-week highs. A breakout accompanied by greatly increased volume is preferred, and stocks that have recently published results that were much better than market expectations, triggering the initial surge or breakout, are preferred. Some trading ideas: near 52-week high and high relative strength. This screen finds stocks with a high relative strength that are about to make a new high, and in the results that are displayed, search for stocks that have formed good bases. These are the results of the screen at the time this video was made. These were sorted by relative strength, and some interesting candidates include, for example, Duolingo, Spotify, and Celestica. New 52-week high and increased volume. This screen looks for stocks that have already breached their 52-week high on significantly higher volume, at least 50% higher than the previous trading session. And some results for this screen apply today. A nice recent breakout on higher volume is visible for Hilton Worldwide. High tide flag. High tide flags are closely related to the standard bullish flag pattern. They exhibit strong price momentum over a short period of time while breaking out of a decent base. The stocks have proper relative strength and the volume decreases during the formation of the flag pattern. Brookdale Senior Living is currently a textbook candidate rolling out of the screener. Squeeze play setups. This screen finds squeeze play setups on stocks that are in a strong uptrend. A squeeze play setup occurs when the Bollinger Bands are inside the Keltner channels. And when this happens, the stock has been trading in a narrow range for a while. A major move could happen when the stock breaks out of its trading range. Tickers MOH and SSP, for example. Bullish retracement screens require an overall market trend that is positive, as the retracement requires a previous significant price rise in an existing uptrend. This strategy is suitable for stocks in an uptrend that experience a temporary price bounce, and the price drop is quite orderly. Volume is low, while volatility and momentum are declining. Some trading ideas: price below the SMA 20 and above the SMA 50. This screen is based on the relationship between the price and two moving averages, being the 20 and the 50 daily moving average. Nice setups from the screen are Copart, Ionis Pharmaceuticals, and finally Berkshire Hathaway. Price near rising SMA 10. This trading idea is similar to the screen before, but more focused on the short term. So price retracements to the 10 simple moving average in stocks that are in a rising trend. And Trax Company and Brady Corporation, for example, are two recent finds using this screen. This strategy assumes that strong price movements are temporary and that prices will eventually revert to their average levels. And for a bearish mean reversion strategy, ideal market conditions are an overall market that is showing signs of a stage 3 consolidation after a bullish trend. And setup conditions, individual stocks that are showing signs of price weakness and distribution after an initial rise, stage 3, or stocks that have risen very sharply in a short period of time and show signs of an exhaustion move. This screen looks for stocks that have broken through their 52-week high within the past 5 days, but have fallen more than 2% on the most recent trading day while closing lower than the previous trading day low. In addition, the previous trading day must have ended positively. And this is a recent failed breakout for Empire State Realty Trust. A clear breakout on the 1st of December, but no follow through, and then some sideways price action and a first test of the rising SMA 10, which has failed yesterday. This screen finds reversals at the Bollinger Band for swing trading in the direction of that reversal. The screen uses custom expressions to determine the reversal condition at the upper Bollinger Band. Macy's, for example, a huge breakout on high volume with a close above the Bollinger Band, followed by a negative trading day with its closing price back below the upper Bollinger Band. Again, these types of mean reversion setups should absolutely be avoided when broad market conditions and sentiment are very bullish. Screening, order processing, risk management and handling of open positions requires a clearly defined structure, and the importance of a process-based trading workflow cannot be overemphasized. It is the most efficient way for daily management of your portfolio. For this purpose, I personally use 3 different watch lists: a standard watch list, a setup list and a list in which I keep track of open positions. For my swing trading strategy, I start from the different Minervini screens, but you can use the same lists for any type of strategy. I go over the different screens several times a week, and I've just added 4 stocks this morning. These are CyberArk, PDD Holdings, Datadog and Backblaze. And for 3 of them, CyberArk, Datadog and Backblaze, I now have pending orders in place. So I'm going to add these stocks to my setup list and delete them from the watch list. When this is done, only PDD remains in my overall watch list. My setup list now has 3 stocks in it. If one of these orders is triggered today, that stock will move from the setup list to my open position list. So in a nutshell, the watch list is for new ideas and possible setups. The setup list is for stocks with pending orders, and finally the open positions list is the place where I keep track of my open positions. And for all 3 of these watch lists, I select the following alerts: earnings alert, news alert, new insider transaction alert, new fundamental alert and new analyst rating alert. And because the alerts are set at the watch list level, I no longer need to configure them for each individual stock. As soon as a stock is added to one of these watch lists, I am automatically notified via mail or push notification if any of the above events occur. The only thing I still use for an individual stock is a price alert. I do that almost exclusively in my standard watch list for stocks that must first reach a certain price level before I consider them interesting as a potential setup. A final very useful feature is the ability to set alerts for your own saved screens or for one of your favorite trading ideas. These are the trading ideas you have liked. For example, if I am following a stock that looks technically very strong, but I am only considering buying if my personal Minervini base screen 2 is also met, and in this case that means that the earnings per share quarter-to-quarter growth is at least 25%, and that the earnings per share has accelerated for at least 2 consecutive quarters, then I can set this as an alert, and as soon as that condition is met, I will be notified. The same can be done for your favorite trading ideas. Risk management is of utmost importance if you want to protect your trading capital and pursue long-term success in the stock market. I could elaborate for a long time on why keeping losses small is so important, but this picture sums it up perfectly. As soon as the loss increases to more than 20% of your total trading account, it becomes really problematic. To make up for a 30% loss, you need a return of more than 40%, and for the 50% loss, that's already an astonishing 100%, just to make up for your previous losses. Investing always involves some degree of risk, but the degree to which you expose yourself to that risk is entirely up to you. A passive long-term portfolio requires a totally different approach to risk than a swing trading portfolio. A fundamental investor limits his risk mainly through diversification. A portfolio containing 20 different stocks, each of equal value, means that each position uses only 5% of the total available capital. The situation is slightly different for a swing trader who is more focused on the short to medium term and sometimes takes positions that are a multiple of that 5%. In ChartMill there is a position size calculator available for that purpose. Simply open it on the stock charts or stock screener page by clicking this icon. Now click once in the chart of the stock. You can adjust the fields at the top. First, enter the total value of your starting capital, so not just the capital you want to invest for one stock, but the total sum you have available to trade. Then set your risk percentage, which is the percentage of your total available capital you are willing to lose if you are stopped out for one position at your initial stop loss. For example, if you enter $50,000 as your initial capital and 0.5% as your risk percentage, then your total loss should not exceed $250. If you want the maximum loss to also take into account broker fees and any other specific taxes, then you can enter them here. Personally, however, I leave those fields blank. To adjust the default values of the calculator, click on your name in the top right corner and select My Account. On the next page, select the tab Position Sizing. Change the fields to your desired settings and click Update Settings. Now, when you access the calculator, these values will be shown by default. Once the basic information is entered correctly, you can use the tool to calculate exactly how many shares you may and can buy, based on your available capital and your desired maximum risk. Suppose I want to open a position in the stock CyberArk software as soon as the price reaches $206 and I want to place a stop loss at $198. If I enter both values, it appears that I may purchase 31 shares. The risk per share is 3.88%. The total investment will be 12.77% of the total available capital. The warning sign next to the stop distance says that the stop loss is less than 2 times the average true range. Personally, however, I use a minimum of 1 time the average true range. If you think the total investment in this one position is a bit too large, there are 2 solutions. Either you move the stop loss further away, for example to 195, reducing the total investment to less than 10%, or you can change your risk percentage to 0.39%, which also brings your total investment below 10%. After all, the wider stop or the lower maximum risk percentage will reduce the number of shares that may be purchased. A swing trader is really nothing but a risk manager, and most of the work is done after the market closes. How I do this myself I will show by using the live paper trading account that I maintain through my Twitter page and which is updated daily before the market opens. This is a Google trading sheet that I created specifically for this paper trading portfolio. The first thing I do is update the sheet if positions were stopped out or new setups or other orders were triggered. Then I go over all the open positions to see if the stop loss can be adjusted. My first and most important goal with new positions is to get a stop loss to break even as quickly as possible without being too aggressive. This section was recorded after the market closed on December 14. I adjusted the stop loss for the tickers highlighted in yellow. MIO has broken out above the existing range and so the stop loss for the remainder can go up a bit. And for HLNE there is a sell order at $116 for half the position. The reason has to do with the important top visible on the weekly chart where some resistance can be expected. Especially when the stock has already risen considerable, I will use such important price levels to cash in some of the profits. selling a bit into strength. As a matter of fact, I did the same with the ticker now. Half of the position was sold on date of December 11 at $705. This price level corresponds to the top at the end of 2021 on the weekly chart. The price did go higher to $720, but yesterday sellers had the upper hand. A drop of almost 5% and volume was very strong. The stop for my remaining position is approximately at 677, which will give me another small profit of 0.45% if the price doesn't open lower with the gap down, of course. My initial risk with each new position varies between 0.5 and 1%. I always start with 0.5%. If I notice that the open positions are evolving well, I will gradually increase the risk percentage to 1%. And since the start on November the 1st, I have not gone higher than 0.75%. In the meantime, I'm back to 0.5%. The stock markets are quite overbought and my last setup in cyber was stopped out the same day. In addition, when I check the screens for new setups, I mostly see a lot of stocks that have already made a serious upward move. Some positions are opened with a risk percentage as low as 0.25%. This is mainly for setups where I see an opportunity below the real pivot point. A good example is the recent position in DDOG. The real breakout did not occur until today, but the close yesterday was also a breakout on higher volume above a bullish flag pattern. Initially, price opened higher than my limit, but intraday the order was still triggered. These are typical circumstances where I use only a risk percentage of 0.25%. So this is how I manage this swing trading account, and that will obviously look completely different for a value or quality investor, where charts and price action are much less important. However, there are custom views in ChartMill for that as well. To do so, click on the inverted triangle next to View. In addition to the charts, there are other categories. Under columns, for example, you can access specific views that focus on quality, growth, valuation and dividends. From here you can also easily access a stock's technical or fundamental report. And through the custom tab you can design your own personal tables or columns. More information on this can be viewed via the video link that now appears on your screen or via the link in the description of this video. What do the vast majority of successful traders have in common? They all keep a trading journal. The exact contents of the diary may vary, but in the end it serves only one purpose: to gain insight into how your strategy has performed over a large number of samples. The more trades the diary is based on, the more significant the results will be. Some traders also add other information, such as their view on the market and prevailing sentiment, the sector and industry from where the setups arrive, how they feel emotionally and how they deal with it, etc. However, the absolute basics are objective performance data that will allow you to check whether the outcome of recent trades is still in line with what you can expect on average from your strategy. A common reason for not doing it is that all that information only provides insight into the past. And in terms of the data, that's true of course. But that obviously doesn't mean you can't learn anything from it that is relevant to your future trades. A good example of this might be the 2021 US Investing Championship, which was won for a second time by Mark Minervini, after he won it the first time in 1997. Because the market environment at that time was very choppy and volatile, there were a lot of stocks that broke out but fell back completely after a few days. A lot of his trades were stopped out pretty quickly as a result. And after this pattern becomes clear from his data, he adjusted his trade management. The rules for entering the market remained exactly the same, only taking profits was done a lot faster and more aggressively. And as a result, he won the contest that year with an astonishing result of more than 300%. The exact statistics you keep track of is different for everyone, but the following parameters are the absolute basics: percentage winners, the average loss, and the average profit. Suppose your average loss across all your losing trades is $250 and your average profit on the winning trades is $650. That info alone won't tell you anything at all, but that changes if you also know that your average percentage of trades that you close profitable with your strategy is 40%. That means that out of 100 trades, you win $640 40 times and lose $250 60 times. Other metrics that are interesting to keep track of: the largest profit position, the biggest loss position, the number of consecutive days that losers are held, and the number of consecutive days that winners are held. Exactly what you keep track of depends entirely on your own needs. However, more tracking requires more time, so always make sure that the information you track has a purpose. For example, if you use several specific technical patterns to base your entry on, you could keep track of how many times each pattern has led to a successful trade in order to find out which is the most successful pattern. Much of the basic data can be automated, with or without specific software, but even a simple spreadsheet will get you a long way. I keep track of numbers on a monthly and an annual basis. On a monthly basis, the difference can be quite large and volatile, depending on the market conditions and the number of setups. But once you have a large number of trades, you will be able to extract valuable information from it over time. There is much more to say on this subject, but that would take us too far in this video. In the book Think and Trade Like a Champion by Mark Minervini, more specifically in section 4, Knowing the Truth About Your Trading, the importance of a trading diary is extensively discussed. Definitely worth reading. That brings us to the end of this somewhat longer video. If you found it worthwhile, be sure to like and subscribe to our channel if you haven't already. And if you don't have a ChartMill account yet, be sure to create one to take advantage of the many features offered by the screener. Registration and basic use of the software is completely free. Thanks for watching and see you soon.